Bryce, bottom line, if the Fed raises rates again, are they making a mistake?
Yes, I think the increase in rates is bad. It's made it harder for businesses to hire people. The economist you just had on, she made a great point by just questioning. I think she knows the answer to this. She said, just think how many people would have come back into the workforce sooner and how many more had the Fed not done anything. I mean, we would have more rapidly correct the supply demand imbalance and gotten rid of shortages much, much quicker if they had, acted sooner and moved slower and help businesses be able to plan better. It would have been less shocking to everyone. As it is, it's been extremely disruptive. You've really hurt banks, you've hurt lending, you've hurt the ability for companies to manage inventory, be able to finance inventory, which makes it even more difficult and more expensive to hire people to resolve the supply shortages and whatnot. But they can only affect demand. So they're a one-trick pony. They weren't even thinking about, hey, maybe it's a supply issue. And the supply problems were created from the fiscal side of stimulus. And so the Fed's trying to, fix a fiscal problem using monetary policy. And it just has not worked very well at all because they can only impact demand really. And that isn't the source of the problem.
Bryce, I want to get your response and reaction to a note from B of A's Michael Hartnett. Mr. Hartnett speaks, people tend to pay attention. He says bonds will stage a comeback in 2024, that as higher interest rates send the economy into a recession. What he told his clients is once the recession being priced by bond and stock markets mutates, he says, into economic data, bonds rally big, and bonds should be the best performing asset class in the first half of 2024. That's Michael Hartnett of B of A. I want to get your reaction to that, Bryce. You think he's right?
I think he is right. I think that bonds could be a great investment without even having that dire situation come to pass. Our core bond portfolios right now are yielding about 6.25, 6.5. If the run rate for core PCE continues at 2.25, that's a 4% real yield. I can't remember the last time we had that. I don't know when we'll get it again. I think it's a fantastic opportunity, and that gap will have to narrow probably in 2024, exactly when he says it will. And if there is a significant weakness in the economic activity, on top of that, just think how rapidly that gap will close. And that will happen with yields coming down quite a bit. The duration of the aggregate bond index is 6. If rates go down 1%, that's a 6-point gain on top of the 6% yield you're already getting. All right, that's a 12% year. That's pretty nice in bonds. And it'd be tough for other sectors to really be able to compete with that, given that poor economic scenario that he's using.